Hi, this is Jim Cunningham. I've got Shannon Behan from Ascent Wealth Management. We are going to talk about maximizing your charitable giving and cutting your taxes. So many of our clients at Cunningham Legal and at Ascent Wealth Management give to charity. So they either give from their IRAs, they give cash, they give in-kind gifts. We're going to talk about ways of being more mindful about charitable giving, which can cut your taxes, can help you out with not only help the charity, but also help you send less money to the government, which I think most of us watching this, when we're doing this live, but most of us watching this, is that would be what we would want to do. This is on YouTube. If you're watching this on YouTube, thank you for watching, and please subscribe to our YouTube channel. And if you're watching this live, and we do these live every Wednesday every Thursday at noon, typically Pacific time, please join us because we do have a Q&A at the end, and we do answer those questions live, but we don't put those up online. So if you would like your questions asked, go ahead and put those in the comments. And if you would like to go to our website and sign up for another webinar, we will answer those live. So imagine doubling your charitable impact while cutting your tax bill. That is not bad to double the charitable impact. We're going to talk about that. We're going to cover donor advised funds. So, or DAFs, DAF is the acronym, but that means donor advised fund. We're going to cover charitable trust. We're going to find out which assets are best to leave to charities, which assets aren't the best to leave to charities, which assets really help your family by leaving to charity versus leaving those assets to your charity. What to do with appreciated assets. You know, a lot of people have assets that have either gone up in value or maybe like real estate or some other piece of equipment. You've depreciated that property. We're going to talk about tax strategies around gifting appreciated property or depreciated property, and then how to manage excess required minimum distributions from your retirement accounts with qualified charitable distributions. And that's a very important aspect of tax planning that I think too often gets overlooked. I'm Jim Cunningham. I'm one of your speakers today. I'm a partner at Cunningham Legal. I've got over 30 years experience as a lawyer. We have offices throughout the state of California. I'm a certified specialist in estate planning, trust, and probate law. I'm a real estate broker, securities insurance licensed, as well as a pilot, single engine land instrument rated, although I am not currently licensed as a pilot. I'm also a third generation pilot. These are the lawyers in our firm. We are dedicated to all things peaceful transfer of wealth from one generation to the next. That includes regular people, wealthy people, business owners with the least hassle, least taxes, least conflict among the family. So we're all about creating a great plan and executing on a great plan. And this is the team at Ascent Wealth Management, and we have Shannon Behan, one of the partners at Ascent Wealth Management, who is a certified financial planner, and she will be doing a lot of the talking this time. So if you're used to me talking, my time talking is almost over. I'm going to read my disclaimer, and then I will turn it over to Shannon. So this is really important. I'm a lawyer. I'm talking. This is not legal advice. This is information. Hopefully we make it mildly entertaining because this can be a very dry topic. But really don't look at this and go out and say, I saw Jim's video. I don't need to hire a lawyer. Certainly you're welcome to reach out to us or any other qualified lawyer. And we cover how to hire a qualified lawyer in my book, Savvy Estate Planning, what you need to know before you hire the right lawyer. So even if you're not in California, if you're in another state, I would encourage you to read that book, and it helps you find the right lawyer. Shannon, I'll turn it over to you. You can start with the disclosure.
You got it. This is the exciting part right off the top. Likewise, I'm a financial planner, but anything that I'm saying today is not necessarily financial advice to you. We are fiduciaries here at our firm, but that is limited to the engagement with our clients. So anything that we say is kind of talking in generalities and encourage you to really do a deep dive into your specific situation with either us here at Ascent Wealth Management or your provider.
So let's start with why charitable planning matters. I'm going to just kind of, there's tax benefits. You can create an income stream when you bunch a gift to a charity and you keep some strings. And I'm going to explain what that is very briefly, and then I'll let you talk, Shannon. And efficient wealth transfer using charitable strategies can help with the efficiency of maybe avoiding or deferring taxes, and then the importance of proper planning, not just haphazard or unplanned planning or emergency planning. So something to understand, there are three ways that you can transfer money to charity. One is you can make a gift. You can just write a check, okay? The other one is you can give something, whether it's at your death, or you can give a stock, or you can give maybe some of your IRA, whatever it is. But one is like a cash gift. Another one is more of an in-kind gift. And the third kind of gift can straddle both of those types of gifts. And that's what the lawyers call a split interest gift. So as we go through these materials, one is just going to be, hey, I'm going to write a check for some money, or I'm going to give something, whether it's a piece of my IRA, an RMD, whether it's a gift of appreciated stock, whatever that is, that would be another gift. And then the third one is what we call a split interest gift. Now, a split interest gift means that if you give something worth $100, you retain some of that gift, or maybe your family retains, maybe they retain 60% of that gift and the charity gets 40%, or maybe the family keeps 90%, the charity gets 10%. So as we go through these strategies, just understand on a very high, like sort of 60,000 foot level, there are different paths to get you to your ultimate estate planning goals. With that, Shannon, I will turn it over to you.
Awesome. Thanks, Jim. So I think, why charitable planning matters beyond the obvious, just contributing to causes that you care about. I think a lot of the times what comes to mind, or that first basic conversation about charitable giving, is simply the creation of tax deductions, income tax deductions. And we'll talk a lot about that today and how it can certainly be beneficial. But there's also ways that we can, using strategic planning around charitable giving, defer capital gains, for example, in some situations, or mitigate capital gains in some situations, depending on what we give and when. As you mentioned, Jim, there are ways to create that benefit your family, but also are charitable in nature as well. There's also a big connection between charitable giving and your overall estate plan, your overall financial plan. All of these things are tied together with strings. So really understanding how the decision that you make in one area dominoes into the other areas of your plan is really important. We see way too often there is not enough strategy involved, and people are very generous and giving, but are not doing that in the most tax efficient way or most beneficial way for their families. So I think there's some unique things we'll talk about today that really create those win-win situations for both charity and family. Off the top, though, we should certainly talk about some of the new things that changed in regards to charitable giving with the One Big Beautiful Bill Act that was passed in July. So I think there's one really neat thing that was rolled out, which is the above the line deduction. Normally, what we've seen in previous years is that people are able to benefit via tax deduction from the gifts that they make, as long as they are itemizing their deductions on their taxes. But now, with this change that's rolling out next year, everyone, including non-itemizers, will be able to benefit from that tax deduction. So up to $1,000 for individual single filers and $2,000 for married filing jointly. So I think for a lot of people who are interested in what we're going to be talking about today, they're itemizing, generally speaking, and not necessarily applicable, but that is one thing just to keep in mind for kids as well too, that are, in lower income brackets and not itemizing. They still can benefit from that charitable deduction now.
Shannon, this is really important because I did see at our church years ago, I did see a report that came out that the people that give the most as a percentage of their income are people that earn less than $50,000 a year. Mm-hmm. So I think this is going to be a really big help for a lot of people to be able to get at least a little bit of tax relief. Now, this is for cash donations to public charities. So this is, not donating your clothes or something, but this is if you're giving cash, whether it's your church or other type of charity or other religious organization.
Mm-hmm. Absolutely. Another big change that came out with the One Big Beautiful Bill Act that we've heard a lot is the AGI, so adjusted gross income floor for itemizers. So for those who do itemize, they have to get over a certain threshold as a percentage, 0.5% of their AGI, in order to be able to deduct it. Now, there's been a lot of talk about this, but for most people who are itemizing, who are doing some charitable planning, this is not going to be a hurdle. For someone who's making $500,000 a year, we're talking about $2,500 in terms of meeting that floor. So I don't think that is super impactful, but what is quite impactful, or potentially for high income earners, is the way that deductions will be taken off of certain tax brackets now. So highest tax bracket at the federal level is 37%. The way that it used to be, you could make a charitable deduction against that 37% bracket. Now they've capped that. So if you are in the 37% bracket, but you're very charitably inclined, making a lot of deductible contributions, those are going to come off the 35% bracket for you. So we've essentially just taken that 2% benefit off of the deductions for those highest income earners. So that goes into effect in 2026. So that does leave a little bit of a window for some planning through this year for 2025 if we are thinking about making certain moves to get those in against the 37% bracket for this year. So we'll talk a little bit more about ways to kind of accelerate those gifts, if you will. We are going to cover in more detail several different planning strategies. We've already teed up a lot of these for you. Donor advised funds. This is a super simple way to, I would say, control the timing of your gifting and the grants out. So if we're worried about getting benefits into a certain year, using a donor advised fund is going to be a great way to do that. I'll tell you all about what it is and how it works. Charitable trusts as well. This is something that Jim introduced, and sort of these are those win-win situations where you're able to benefit not only your family, but also a charity as well. There's a couple different structures that we usually see: charitable lead or charitable remainder. Really, the main difference there is who benefits and when. Is it you and your family when you're alive, or a charity while you're alive? And then vice versa at your passing or at the end of the term of the trust, who benefits at that point? Charitable lead trusts are something that is very attractive in an environment where interest rates are low. So we may see those come more into play as if we continue to see some interest rate cuts. They're a great strategy where you're able to create a remainder for your family, create a gift to your family, get those assets out of your estate out into the future, and then have a charitable stream go out to that charity during your lifetime. The opposite of that, the charitable remainder trust, is what we'll talk about in more detail today. That's a really cool structure where you can create income for yourself while you're alive and get an immediate charitable deduction, but that charity is going to benefit on the back end. Donating appreciated assets. This is something that in my conversations with clients, I think this is oftentimes one of the biggest gaps. People are not thinking about donating or funding charitable trusts, for example, with anything other than cash or liquid assets. And they are, quite frankly, leaving money on the table. It's not the most tax efficient way to do it, is cash only. So we'll give you some examples of why we should start thinking about, hey, if we have very low basis Apple stock, for example, that we've owned for a long time, are there ways that we can utilize that without realizing capital gains? That also would apply to things like a very low basis real estate you've depreciated over time, or even a business interest. Anything that has a very low cost basis with a lot of appreciation built in, we can start to get strategic around it. And then last but not least, we'll touch on qualified charitable distributions. This is a really neat tool that allows you to make a donation to a charity directly from your IRA without increasing your income. And we'll talk about why that matters. But that is definitely an overlooked tool that we see going unused, certainly. So we'll start with donor advised funds. I would think of these as a charitable savings account. The way that they work is you essentially establish an account, you make a contribution into that account. Let's just say it was cash, but you could also do appreciated stock in there as well, which could be super beneficial. But you make a donation into that donor advised fund, you get the immediate charitable deduction for giving that gift. The ownership of that asset is no longer yours. It's now out of your estate. However, those assets can remain inside your charitable savings account, invested, and continue to grow over time, thereby compounding your charitable impact. And then you and your family decide when to actually make distributions out to the end charities from that charitable savings account. One thing I also really like about donor advised funds, and kind of going back to why charitable planning matters, I think having that charitable legacy for your family or creating those discussions, kind of the qualitative aspect of charitable planning in addition to the numbers, you can actually name your children, for example, as successor grantors on your donor advised fund. So if you are contributing to your donor advised fund, getting those deductions along the way, those assets are invested and growing over time. And when you pass away, there is still a pool of funds that you have yet to make charitable grants. You can give that right to your children. And so then your children can get together and decide, hey, we have this pool of money. How do we want to utilize that and grant that out to charities to make the most impact? So really a cool tool, not only from a deduction perspective, timing of deductions and gifts, but also from that, call it charitable legacy perspective.
I would say I'm really glad you talk about it at the donor advised fund as a charitable savings account, because I think this is very confusing. People think, oh, donor advised fund, trust fund is fund money. No, fund is actually an account. It should better, like donor advised account, I think is a better description of it. And what a lot of people do, we're going through what we call the holiday season. So we just had the Jewish holidays. As we're recording this, we're in the middle of the Hindu holiday Diwali, which is a festival of light. We've got Canadian Thanksgiving, we've got American Thanksgiving, and then we have the Christian holidays in December, and of course New Year, and then Chinese New Year following that. So we are in the thick of the holiday season, and I think a lot of people take time and they reflect on maybe the fact that things that maybe have gone their way financially and they want to give back and they want to spread that around. The nice thing about a donor advised fund is, we have this end of year deadline if you're a 1040 filer and you say, you know what, I'd like to dedicate $100,000 to charity. It's December. What's the latest they can open a donor advised account with you? Shannon, December what?
I would say give us a call by December 10th, but we could probably do it
December
after
10th.
that. But you don't want to, you want to under promise and over deliver.
Yeah. So let's say you meet for Thanksgiving and you get together with your family and maybe you talk about, hey, let's all give back. And so you can set up this donor advised fund after Thanksgiving, but you don't have to think about who gets that money, right? So the money doesn't have to go to the charity in 2025. The money has to go into the donor advised fund or this charitable savings account. Ascent Wealth Management has charitable savings accounts, and that money has to go in there. And then next year you advise the charity, or maybe year after or the year after that. This is very important. You advise the charity. So if you said, I want to have a balloon party for all the squirrels in my neighborhood. That is not a charitable purpose. That is not going to happen. You can advise them that you want a balloon party for the squirrels in your neighborhood. Not going to happen. But if you say, gee, I'd really like to help out the local, food pantry, right? So to help out people who can't afford food, and that's a charitable organization, that's more in line with a charitable purpose. And so that's typically what you advise them. And then many times, in fact, most times, I don't want to comment on the charity that's holding the funds, but as long as it's not too wacky, I think those funds are typically spent the way that you advise those funds to be spent. They're not under your control. That's very important. It's not like having your own charity. It's not like a charitable endowment where you dedicate some money to like an educational institution, but you're advising the charity on how you want the money spent. But that's something you typically set up through a financial advisor, and you fund with cash. Can you fund it with anything else, Shannon, with your deaths?
Yeah, you could absolutely use appreciated stock, for example, to fund a donor advised fund, very low basis stock. And then what happens in that scenario is you avoid actually selling the stock, realizing the capital gain. And then you only have what's left to contribute to the donor advised fund versus donating the appreciated stock. Or even complex gifts in some situations like real estate or those sort of things. You can even use those to fund donor advised funds. But in that situation, once it's in the donor advised fund, then it may be or likely would be liquidated, and there is no capital gains tax paid. Nobody pays that tax.
So it's a great way. I think it's a low lift. It's I would say probably the least headspace of some of these gifts that we're going to be talking about for people who have a busy life, but they want to give to charity, but they just don't have time to figure out how to get the money to the charity. So lots of our clients do this, and I think they're really happy with them.
Absolutely. And donor advised funds are really, really useful for bunching, which is this idea of sort of contributing a lot of assets at once in 1 year. A lot of people do this to get over the standard deduction limit, so that they can then itemize. Especially, we might not see that as much with, or we're seeing that more now with the standard deduction limits being so much higher. This is also an opportunity to, again, remember that change from 37% to 35 in terms of the highest benefit that you can have on a charitable deduction. If you make those deductions, if you are thinking of doing a gift in 2026, if you make it in 2025 into a donor advised fund, for example, you can benefit at the 37% bracket. Apparently, I haven't had enough coffee today, and benefit from it this year. So, accelerating those timing strategies around contributions is really what bunching is about. And a great planner can help you decide, when's the right time to make those decisions. Donating appreciated assets, I think this is something that is so important. As we've talked about, if you had, let's say, for example, you had $100,000 of stock, well, that was near zero basis, for example, and you wanted to utilize those funds for charitable purposes. If you simply sold that stock in your brokerage account and you lived in California, let's assume, you might pay $35,000 in taxes on that sale. That leaves you with $65,000 that you're then able to gift. And then that $65,000 would be your deduction amount. Versus if we were to fund a donor advised fund or some sort of charitable structure with that stock before we sold it, that full $100,000 value is the amount of your charitable contribution that can be deducted. And then in many cases, that capital gains tax is either not paid, as in a donor advised fund, or if you use it to fund a charitable trust, oftentimes that tax is then deferred out over a number of years. So it can be really impactful to donate this way, as it's really one of the most tax efficient ways to donate. And I think it's often overlooked, especially when we're thinking about charitable vehicles like a trust, real estate, any sort of very low basis asset would be a good candidate for this.
Yeah, and this is also for those of you who would like to get in the habit of doing things that ultimately result in you paying less tax, which, just get your head around that for a moment. That's a multi-year process. So I'm a tax lawyer. One of my hobbies is figuring out how can I reduce my tax bill, right? That's just kind of what I think about a lot. I do that for my clients, right? So one of the things that you can do is if you say, gee, I'd really like to give $100,000 to XYZ charity. You can write them a check for $100,000, or if you have this low, as Shannon gave the example, this low basis Apple stock, you say, I really like my Apple stock. I don't want to give away my Apple stock, but you know what? I'm going to give away this lot of Apple stock that's worth $100,000. Same day you go out in the open market and buy the Apple stock, what you have just done is raised your cost basis from $0 to $100,000 in that stock. So this is basis management. So when that day comes where you say, I'd like to liquidate that particular lot of stock, you're going to be paying, in this case, $35,000 less in capital gains tax. So this is part of the habit, and habit is a word. It literally means in Middle English what you wore. Like a habit would be like a tunic that you would put on. It was clothing. So it's something that you do every day or that you do periodically. This is a habit that you get into to pay less tax over the long term. So this is just one of the many things that our clients do and that I do personally to keep my overall tax bill lower.
We've touched on this several times, but this is just about the timing of these charitable decisions, and having them align well with the financial events in your life. So whether that is something like selling a business or a major inheritance that comes in where you've got a lot of liquidity in a certain year, or you have a super high income year, you've got some sort of special performance bonus that comes in, being strategic about timing your charitable giving to maximize the offset that you're creating, using some of these tools that we've already touched on in creative ways that help you control the timing of the benefits and the grants out. And again, just really making sure that it's integrated with your overall plan, both your financial plan and your estate plan, is really just aligning all of those interests, your family's interests as well as the charitable interests as well. Charitable Remainder Trust. This is one of my favorite vehicles. I think it is a really wonderful example of a way that you can benefit both your family immediately and then also create a charitable legacy as well. We talk to a lot of clients who are already doing a tremendous amount of giving and are very generous, and that's wonderful. We applaud them. Our goal there is to optimize the way that they're doing that. But I would say, even if charitable giving is not currently a part of your financial plan, I think this is a wonderful opportunity to consider how you might be able to utilize a vehicle like a charitable remainder trust to create some benefits for yourself, and then also have that ripple effect of the charitable impact as well. A charitable trust is a vehicle, the charitable remainder trust is a vehicle that you can fund, again, with appreciated assets, a lot of times is what we see with our clients. You receive an immediate tax benefit for making that contribution, not of the full amount of your contribution into the trust, because remember what Jim said, this is kind of that split benefit situation where it's not all going to the charity. So there is, some amount of it that will benefit your family. So you make that funding of the charitable trust, you get that immediate tax benefit. And then what happens is charitable remainder. So at the end of the term of the trust, which could be 20 years, it could be your lifetime, the charity gets the remainder, what's left. But while you are alive or during that term, you create an income stream for yourself. So generally we see that as, as an example, 5% a year. So you donate $1 million, you get 5% a year out, $50,000 a year. And the really cool thing about this structure is that if you donate with appreciated stock, you then have the ability to sell that stock within the trust vehicle, diversify those investments. Or let's say you fund the trust with real estate, you sell that real estate, and you can put those funds into the stock market, for example. And then you're not stuck with that huge capital gains tax bill all at once. That income stream that you create for yourself, that is going to be taxable in the same way that the gains would be taxable had you realized them at once, but you get to realize that over time. So if it's a massive capital gain, you're not getting hit with it all at once. You're realizing it over time as that income is coming out to you.
Yeah, and just an example of how a charitable trust can work. Let's say somebody retires at 60, and they say, I'm going to liquidate $100,000 of this Apple. We'll use Apple again. Let's say a person has $1 million in Apple stock, but they're worried. They go, Apple could go up, it could go down. Full disclosure, I own Apple stock. I hope it keeps going up. So that would be great if it did. But if you're 60 and you have $1 million in Apple stock, you say, that makes me a little nervous. So what you could do is take that $1 million stock, put that into a charitable trust, sell the entire portfolio, sell the entire position of Apple stock, reinvest that, and you could take out 10% a year for 10 years, right? So now a charity has to get at least 10%. So if I put something into a charitable trust, a charity has to at least get 10%, and that's based on interest rate and my age and the term of the trust, and there's a lot of math in there. But just understand that a charity has to get only 10%. You can keep that 90% benefit, and that is an effective way of using tax deferral. So selling that stock and maybe taking out $100,000 a year. So at the end of the term, maybe $200,000 goes to the charity. Maybe it's $150,000. I'm assuming that there's a little bit of return in there as you as you hold that portfolio. The other really cool thing is if you're 60 and you haven't started yet taking RMDs or Social Security and you have no income, that $100,000, if you're married filing jointly and you have no other income, you're paying, I don't know, a couple $1,000s in federal tax on that. So it's very important if you can stretch out your capital gain in the years post-retirement, but before your required minimum distributions from IRAs, you don't have necessarily a lot of income. And that's a really great time period, that sort of 60 to 73 time period. That's a really great way to take advantage of those years where you don't have a lot of taxable income in order to manage the basis of your property, right? In order to pay the least taxes. Great strategy.
Here's putting some numbers to that. In this situation, the donor has $1 million of stock with $200 of cost basis. They put that in a charitable trust. They're 65. Again, assuming they live in California, they could be saving almost $300,000 in immediate capital gains tax on the sale of that particular position. Creates an income stream out to them that, again, is extending that taxation of the capital gains. And it's also creating an immediate tax deduction for them. In this case, with these numbers, it'd be about 450 that you'd get as a charitable deduction immediately. So it's benefits on a lot of fronts. And I really like how flexible the CRT structure is as well, too. In terms of number of years and amount of distribution. Are we trying to maximize the current tax deduction? Are we trying to, maximize the total amount of income that comes to the family? So these can really be tailored to your specific situation and your family, your needs and your goals. Absolutely. All right, choosing the right asset. Not all assets are created equal. We've talked a lot about how to use appreciated assets like stocks, business interests, those sort of things. But oftentimes, there's the flip side of that coin, and that's what is left in your estate after you've given these things away, and how is that going to impact your heirs? So, I think a lot of the times, even the most basic decisions around, let's say you've got a very large IRA. You've got a very large tax deferred account. If you have both your children and charities as beneficiaries on your estate, and you name your children as the beneficiaries of your IRA, you are essentially passing along a tax bill to your children because those assets have never been taxed. As the beneficiary of the IRA, your children will have to pay income taxes on those amounts. However, if you list one of the charities as the beneficiary of the IRA, that charity is not subject to the same income taxation on those assets. So absolutely, that simple choice of, naming the charity as a qualified beneficiary saves a lot of income taxes. Same line of logic, if you have a brokerage account, for example, or real estate that is low basis, that's not in a qualified account, when your heirs receive those through your estate, they get that step up in basis. So they get a reset on their cost basis. That appreciation that happened during your lifetime, that essentially goes away. Nobody has to pay capital gains tax on that. So it's really important that we are strategic about the asset selection for what goes to heirs, what goes to charities, and in what proportions.
Let me give you a really easy example to understand. Let's say there's a mom has one kid, son. She wants to leave half of what she has to her son and half of what she has to a charity. Just assuming, and assume the son's okay with that. Not all sons would be okay with that, but this son is. Mom has $1 million in the bank and $1 million in an IRA. Mom can have the son get half of what's in the bank account. So the son would get 500,000 of the bank account. The charity would get 500,000 of the bank account. The son would get 500,000 of the IRA. The charity would get 500,000 of the IRA. The problem is the son ultimately will have to pay income tax on that $500,000 IRA that the son inherits. Now, just get your head around this. If the son gets the $1 million in cash and the charity gets the $1 million in IRA, the son saves a couple $100,000 in income tax on that $500,000 IRA. So really beneficial to be very mindful. And this is why I will say, Shannon, one mistake, if I can call it a mistake that people make, is they kind of think that all lawyers are the same, that all lawyers have equal competency.
Mm-hmm.
I got news for you. A lot of lawyers do not understand what I just said. So a lot of estate planning lawyers just simply wouldn't get it because they don't even understand how IRAs work when somebody dies. Okay, so this is why you need to find an expert. This is why you need to find a savvy lawyer. And again, that's in my book, Savvy Estate Planning, shameless plug. But that's a great way. It's a great guidebook. So if you're looking for a lawyer, obviously when you're in California, give us a call. But if you're in another state, it's a great way to look. It's a great way to help you find the right lawyer. And that's what the book's all about.
Awesome. Qualified charitable distributions are one of my favorite underutilized tools. Remember, they allow you to make a distribution straight from your IRA to a charity. One of the, let's call it a loophole, if you will, is that you can do it when you're 70 and a half. This used to align directly with the beginning age for required minimum distributions for your IRA. But subsequent legislation that changed that RMD start date did not change the QCD date. So that's very important to note. 70 and a half is when you can start doing qualified charitable distributions. The reason that they are such a unique tool is they allow, for those who do not make itemized deductions, they benefit them incredibly because you're able to make that deduction directly to charity, and that distribution that you've taken helps meet your RMD, but it does not increase your AGI. Very, very important
Why is that important if you get Medicare?
because of IRMA. So the higher income that you have, the more you pay for Medicare. So that keeps the phase outs for Medicare and any other phase out. The lower you can keep your AGI, the more you're going to benefit on several different fronts. And I think QCDs are another recent change that was made to QCDs that's important to note too, especially for our higher net worth, is they used to just be a static 100,000. Now they're indexed over time. So this year it's 105,000. Over time, that will increase. There are some limitations on donor advised funds. On QCDs, you cannot send a QCD directly to a donor advised fund. It actually has to go to a charity. So that's one thing to think about as well, too. If you're pairing some of these strategies, if you want to do QCD and fund a donor advised fund, you want to make sure that you're thinking about what goes where and when. So if you are not itemizing, absolutely consider a qualified charitable distribution. But even if you are itemizing, they can still be a really impactful tool to keep that AGI low. And again, because you can start them at 70 and a half, it's really impactful to start making those qualified charitable distributions prior to your required minimum distribution starting, because you are lowering the future RMDs that you will have as well too.
Yeah, and a good example of this is, let's say somebody says, I'm going to give $5,000 to whatever charity. I have $100,000 in my IRA. Your RMD is a little bit under. I mean, maybe it's $4,000, something like that.
Mhm.
You can make that charitable contribution of $5,000 from your IRA.
Mhm.
And the nice thing about that is not taxable as income to you, because if otherwise you take the money out of your IRA, or whether it's an RMD or you voluntarily sort of take that money out, you're going to have to add that $5,000 to your income. And if you make a gift of $5,000 to a charity and you have no other deductions, maybe your mortgage is paid off, you're going to be taking the standard deduction. So it's much more tax efficient. You believe it or not, you end up with more money in your pocket at the end of the year by giving from your IRA than you would giving from cash in your bank. Counterintuitive, because a lot of you think, well, I'm going to get the maximum benefit if I write a check. No, it's going to be your IRA. But what happens in the background? Let's say I want to give to a small charity. They don't have a brokerage account. How do you do a qualified? How does a qualified charitable distribution work?
Yeah, the way that we operate here with our firm and our custodian is we make the request to the custodian and say, from Jane Smith's IRA, she wants to donate to XYZ charity. If there is not a wiring instructions, for example, they'll just issue a check directly
Great.
out of your IRA and send it right to the charity. They'll verify, of course, that it is a 501(c)(3) charity, but they handle all that on their side. The other thing that has changed recently is now our custodian will also be keeping track of qualified charitable distributions for tax reporting purposes. This is something that didn't always happen and still doesn't always happen. So what we were seeing is people were making qualified charitable distributions from their IRA right to a charity, but the custodian and their advisor was not capturing the fact that that QCD had happened when it came time to report the taxes. So they were still paying income taxes on those QCDs that they had made, implementing the strategy, but not benefiting from it.
And I would say this is a reason to have a financial advisor, and this is really a case for using somebody like you, Shannon, is if you're a DIY, you may not even know how to connect the dots, and then you get your 1099-R, right? And you just add it to your income if you're doing your own taxes. This is why, and again, this is counterintuitive. People say, well, I had a CPA, I had the advisors when I was working, but now I'm retired and it's really simple. No, it can get far more complex as you enter retirement. So it's something to pay attention to.
Absolutely. We kind of talked through the QCD
Okay.
example, so I think we can skip to the next guy, which is just talking about, again, I know I'm sounding like a broken record, but I think it is so important that you coordinate your charitable giving with your estate plan, with your financial plan, because those things that we talked about, like who you're naming as your IRA beneficiaries, that seems like such a simple choice. But to Jim's example, it can cost your heirs hundreds of thousands of dollars if we don't do it right. Creating that legacy with a donor advised fund or considering a charitable trust that can benefit both your family and the charities, that can really be an impactful way to also lower your estate in the future so that your heirs are not subject to estate taxes, at your passing as well too. So all of these things are connected. And I'll mention it one more time because I just love the idea of it, is that qualitative aspect of creating that philanthropic legacy in your family. I imagine, kids sitting around the kitchen table together and making decisions about which charities they want to grant to that year from the donor advised fund, for example. I just think it's a nice way to instill those values in your family.
Yeah, it's I'm so glad you mentioned this because thinking in the context, and I will say one common question I get from people is they say, I'm Christian, I tithe, which, and for those of you who don't know what tithing is, it's where you are to give 10% of your net increase. So whatever your net, like you think of harvesting grain, tithing would be giving 10% of that grain harvest back in the day. I've done a little bit of research on this, and what my research has revealed, like at least in Christian theology, and I don't profess to be a Christian theologian, that does not apply in the case of death. So in the case of death, it goes, if you have 3 kids, maybe it goes equally to the children. I have not seen yet a theological requirement in what I've looked at that requires that tithing of 10% of your estate. So it's a question that comes up a lot with clients, Christian clients that have that question. I can't speak for other religions because I don't know, but there's this melding, and I mentioned this philanthropic, this giving back, this sort of sharing with people who and causes that are less fortunate or need the help. I think again, for those who are blessed with much material abundance, much is asked of them, right? And that's, by the way, this is true in the tax code. Rich people pay most of the taxes. As much as you hear that rich people don't pay their fair share, half the people in the United States don't even pay federal tax. So a lot of the people with the assets, those are the ones who are paying the taxes. Those are the ones who many times are giving to charities as well.
Mhm. Common mistakes. This is really just summarizing the things that we've already talked about, right? So using the wrong asset in gifting. We see this all too often. Selling and then gifting, for example, or naming the wrong beneficiary on an IRA account, that sort of thing. Missed QCD opportunities, especially in those years when you are eligible to do qualified charitable distributions but have not yet started RMDs. These can be really impactful, a wonderful way to meet your gifting goals, and really in an advantageous way for you. Misalignment with timing of gifting as well too. That's why I think, again, that charitable savings account with a donor advised fund is such a powerful tool. It really leaves all the control on timing in your hands. And then again, ignoring that estate integration, not considering how one aspect over here has those ripple effects throughout your entire plan.
The nice thing about making a charitable deduction, something. Let me give you a little background for if you're watching this or listening to it. It's very important to understand that California and the federal government, although they each collect income tax, California does not always follow federal rules, and in many instances, it deviates from those federal rules. Next webinar, we're going to be talking about oil and gas as a potential investment and tax deferral strategy. That only works for federal. California took away this sort of the immediate tax benefits. They're spread out over a longer period of time. A charitable deduction solves not only for your federal tax liability, but also state tax. And what we're talking about here is a deduction. If you make a gift of $100,000, that is deducted from your income, meaning you're saving up to $37,000, well, $35,000 in 2026 in federal tax and up to 13.3% of that $100,000 in state income tax. So it's one of the only areas that gets you both a federal and a state benefit in the year that it is given. So very, very powerful for those of you who are subject to California income tax.
And that's why we're talking about it. That tax benefit, reduction of income taxes, deferral of capital gains, or in some cases, even elimination of capital gains tax, potential estate tax reduction in the future. That's one of the biggest reasons that this needs to be a part of your conversation with your trusted experts. That income stream creation, the benefit that you can have to your family as well, to using those varieties of tools that we've talked about. I think there's a lot of really neat tools in the toolkit. So just getting strategic about that thinking. And I really encourage you to have a CFP, a certified financial planner, involved in this conversation. Much like attorneys, Jim, there's a lot of people that call themselves financial advisors that don't necessarily know all of the ins and outs of this.
Yeah.
And some missed opportunities could be left on the table. So, even such things as the opportunity to really accelerate gifting into this year to take advantage of that 37% bracket. Those small details add up and compound over time. So it's just so important to get your expert team in place to help make sure that you're meeting your goals in the most efficient way.
Well, that brings us to the end of our time together. Thank you so much, Shannon. Thank you. Such a great content that you've shared this information with whoever is watching this, with you who's watching this. These are our office locations: Cunningham Legal in Northern and Southern California. And here is the contact information for Ascent Wealth Management. So if you would like to talk to Shannon about your financial situation, about setting up a donor advised fund, about like, hey, Shannon, I really need to find a financial advisor because it's a scary world. A lot of stuff's happening in the world that I don't understand, and I'm worried about my finances. Shannon is your person, and they are located, multiple locations, multiple phone numbers. All paths lead to Shannon. So we will now open it up to questions. If you're watching this on YouTube, then another video is going to roll right after this one magically.